survey at this meeting. But market rates and surveys of analysts both show further progress towards the 3% objective. Core goods prices are benefiting from exchange rate strength. Food price inflation seems to have peaked, although we have a small upward revision to this forecast, mainly from beef prices. Services inflation is unchanged from the last meeting. The announced medical aid increases are lower than last year's. At the same time, housing inflation has accelerated, which warrants ongoing scrutiny. We assess the risks to the inflation outlook as balanced. Against this backdrop, the MPC decided to reduce the policy rate by 25 basis points to 6.75% with effect from the 20th of November. The decision was unanimous. Members agreed there was scope now to make the policy stance less restrictive in the context of an improved inflation outlook.
If you are like many of us who's got debt, financial commitments in any form, be it a credit card, personal loan, car finance, or even home loan to that matter, I think this episode would be of so much value for you. We'd also be looking at the role of the Reserve Bank or South African Reserve Bank, SARB, in the financial system or the economy entirely. We'll look at their influence in as far as interest rates are concerned. We'll also look at how they determine the rate of inflation, right? Bagaetsho, dumelang, and welcome to this edition of the Balcony Dialogues. If you are watching for the very first time, I go by the name of Katlego Khositlo, and short as I prefer, Katlego Khosi. Welcome to episode 12 of TBD. So, for those who have been part of the TBD family, we started this journey of podcasting last year around this time, and I have committed to doing at least or dropping an episode per month. So if you look at it, we've done a full cycle of 12 episodes. I wouldn't have done this on my own. I've had so much people supporting the podcast through subscriptions, liking and watching the content, even as far as buying the merchandise for the podcast. So thank you guys for your support. It really gets me going. Now let's get to the burning issue or the burning topic of this edition. Before I even get into the meat of this episode, I really want us to get to the definitions or unpack the jargons that are often thrown around, and for people who are not financially literate or who don't read much about financial concepts, these sometimes can be very intimidating and can get you not to be interested. And it comes at a cost to you, because then it means if you're not aware of certain things, you get to make decisions as you go, and often you make mistakes because you're not aware of what's going on or what these things really mean, right? So we are going to be talking about the role of the Reserve Bank in as far as regulating the banks. They are also the lenders to the banks. They do control the flow of money in and outside the country. Those are just some of the functions of the Reserve Bank at high level, right? But within the Reserve Bank itself, there's a committee called Monetary Policy Committee, or MPC as they like to call it, right? The function of this committee is purely to look at financial stability through managing or regulating the level of the interest rates in the economy, and even keeping inflation to their target or their pursuit. So this committee consists of the Reserve Bank governor himself, Ntate Leseja Kganyago, his deputy, and in that committee also, I think it's a mix of economists and researchers who on the background would be working in collating data that tells them that this is what the economic outlook is, the inflation, this is what it could be, and what is the best decision that they can take when they sit at every quarter on a round table. So they sit and then they vote whether they're going to increase interest rates or the repo rates, decrease them or keep them as they are. This is the committee that we all love to hate because they determine how much you're paying on your financial obligations, on your credit cards, on your home loan, because if they decide to increase interest rates, what that means is that you're going to be paying more than what you've been paying. And for what most of us like, if they decrease interest rates, then it means there's a bit of more money in our pocket, right? I really want us to define what inflation is, which is the level at which the cost of goods and services increase over a period of time, right? So this is a measure by percentage wise of the level at which goods and services would have increased. The things that really forces inflation to, or forces the price of goods and services to go up, it's mostly driven by the cost of importing goods and services into the country, the cost of production, cost of raw material, the cost of electricity, cost of fuel, and the cost of agricultural products, for example, because those are the type of products that we consume on a day-to-day basis. So at any point when this increases or when inflation is going up, it means you and I will be paying more for us to be able to buy bread, milk, and all these sorts of things, right? So the key role really, as I've mentioned, of MPC is to regulate that inflation does not shoot the roof, because then it means if it's too high, it's going to be very difficult for households to afford goods and services, right? So that's what the key mandate for the MPC, or the Monetary Policy Committee within the Reserve Bank, focuses on. And we can go in and on about the role of the Reserve Bank beyond the MPC mandate, right? So they regulate the flow of money in and outside the country. I think you guys you hear about the terms like illicit flow of money. What that means really is that the Reserve Bank regulates the amount of money that's coming in and outside the country. So at any point in time when you are going to be taking money outside the country over certain limits, you can't do it willy-nilly. You have to go through the Reserve Bank and report that I'm taking out this amount of money to this specific country and for these reasons. Once you get an approval, then you can do that. Similarly, if you bring in money into the country, you also have to go through via the Reserve Bank. And these are very serious things, because if you don't adhere to these requirements or rules and regulations, they are very serious, because you can end up facing imprisonment, fines, actually, monetary or financial penalties, either on your personal capacity as a director of a company, and even if you are employed by a particular company and you are doing these decisions, it can actually impact you personally. The other role of the Reserve Bank is to, I mentioned, they regulate the banks. So this is how they do it. There's this thing that is called capital adequacy. What this means is that the Reserve Bank, every now and then, they check into these banks to make sure that they have adequate deposits that they have in their balance sheet. The reason to do that is to ensure that there's financial stability. I don't know if you guys remember, there was a case, there's something that really happened, I think around 2000. There used to be a bank called Sambo, right? There was a panic in the financial system, and then people were rushing to the bank to draw their money to this bank. And so this is what they call the run for the bank, where you and I tomorrow we decide to go to our banks and draw all our money because we don't trust that our money is safe. That's what happened to Sambo, right? The implication of this is that it can be very heavy and have really negative implications on the entire economic system. So the Reserve Bank is making sure that every single bank out there has adequate capital requirements or deposits to ensure that there's financial stability. At any point when you want your money, the bank should be able to give it to you. So what they are doing is to make sure that banks have got adequate money to be able to deal with these deposits or withdrawals as they happen on day to day. If they can't do that, that can be to the detriment of the economic system or the collapse of the economy, right? So those are just like high level some of the things that they do. So it's really around compliance and monitoring and supervising the banks. At this point in time, you must be now wondering what determines or what pushes the MPC to either increase or decrease the lending rate, right? So there's two types of interest rates for the purpose of this discussion, right? There's the repo rate, which is the rate at which Reserve Bank lend money to the banks. Don't forget, very important. The rate at which Reserve Bank lend money to the banks. And then there is the prime lending rate. The prime lending rate is the rate at which you and I, when you go to the bank, they will be guided by that rate to say, for us to be profitable, because we lended from Reserve Bank at 6.67%, obviously for us to be profitable, our rate, which is the prime lending rate to the consumer, should be higher, which is currently 10%. So the difference between the repo rate, 6.67%, and the 10% or 10%, which is the prime lending rate, that difference, it's the spread or the profit that banks can make. However, banks can actually decide to even charge you more than the prime rate. So prime lending rate is a guiding that says this is how much you can start to charge your customers for you to be profitable as a bank, right? The other thing that people mostly are not aware of is the fact that banks actually use someone else's money to lend it out to someone who's looking for a loan. So someone has got cash surplus, they put it in ABC Bank, they get, let's say, 5% interest. The bank takes some of that money, lends it out to someone else who needs a loan at a higher interest rate, higher than what they are paying to the person who has surplus cash. So can you see how it works? Surplus cash the bank pays you 5% of interest. Someone comes borrowing money, the bank charge them, let's say at prime, 10%. They still make profit of 5% spread of that. So that's just how banks makes money, right? So the MPC uses the repo rate. So I think it's also very important for me to clarify this. There's a positive correlation between the increase and the decrease between the repo rate and the prime lending rate, right? If Reserve Bank increases the repo rate by a percentage, it means the prime lending rate will increase by the same amount. If they decrease the repo rate, it means the prime lending rate will also decrease at the very same percentage level, right? So that's the correlation between the two. It can be that the repo rate increase, but the prime lending is constant. That's why every time when there's interest rate increase or decrease, you'd get a letter from your bank to tell you that effective immediately, your interest rate will either decrease or increase, piggybacking on the MPC decision to either increase or decrease the interest rates. The other thing is that the impact of increase in either interest rate, in increase or decrease in interest rates, this is how it can impact you. It can actually impact you in two ways. If you have surplus cash, you put it into the bank, and then they give you a 5% interest rate, variable. So it means you are earning a 5% of surplus cash that you are lending or that you've invested as a cash deposit into the bank, right? If interest rates decrease, it means you're gonna get a lower interest because the interest rates have come down. So it means you who have surplus cash, generally, your rate of benefits or rate of interest income will be lower. Similarly, if you have a loan, you're paying 10% interest to this bank. If interest rates increase, it means you are going to pay more interest off your pocket. So what I'm trying to paint is there's two sides of it. There's someone who has surplus cash, and then there's someone who doesn't have money or who have a loan. You have surplus cash, you've invested it in a 32 days deposit. If interest rates decrease, it's not to your benefit because it means the interest rate that we've been getting all along was higher and it's going to be lower, right? And if interest rates consistently increase and you have surplus cash, it means it's to your advantage. So this is how the MPC regulates the inflation. So as you guys can remember, we used to say inflation target is between 3 to 6%. What that was meaning is that the MPC looks at the level of inflation and say, is it between the target? If it's within 3 to 6%, then there's no need really most of the time to increase or decrease. They would keep interest rate stable over a particular time because it's within their target, right? That was then before the new inflation target. If at any point in time during the 3 to 6% target, if inflation was going to be 7%, then that is when the Reserve Bank would come in to increase the repo rate so that there's less spending into the economy. As soon as that happens, it drives inflation down. Similarly, if inflation is so good that we had said is 3 to 6% the target, and let's say it's below 3%, which means it's very good. If that happens, the Reserve Bank will look at opportunity to to stimulate the economy. Stimulate the economy meaning they will have to decrease the interest rate so that people can afford debt, and as they can afford debt, then there will be more spending into the economy, right? So that's just how it takes place. I hope you guys didn't lose me there. But that's what it means. There may be also confusion of, I said the prime lending rate is the rate at which banks lend money to you and I, right? It's a guide. So that's what tells them that you can start charging from from here up to whatever the percentage, right? They are actually not forced to give you at prime. That's why sometimes if you have a very good credit rating, you can actually buy a car or even a house at prime minus 1%. What that really means is that you are still getting a very good rate compared to someone with a very high risk profile that can get up to like 20% of interest. It also depends on the type of products that you are buying. So if you think like a bond, which is far more long term, it's even also secured. What that means is that the bank generally would not charge you a high percentage of interest rate because it's a secured lending where if you don't pay, they'll come and repossess the house and sell it to someone else. But for products like unsecured lending, where it's just a personal loan or a credit card, you can actually pay a high interest rate, way higher than the prime lending rate, right? Which, like I'm saying, it's determined by your risk profile. Risk profile is basically your credit score. How does it look like? That's why I can go into a bank and get charged a certain percentage of interest, and then someone walks in and they get a way lesser percentage than what I got. That is determined by your credit score or your credit rating. The bad your credit score, it means your credit profile or your risk profile is too high and will generally be charged high interest rate. If you have a very good credit record, then it means your risk profile is very good and you'll get a very good rate of interest. Someone without debt at all, you don't have a clothing account, you have nothing to your name, your risk profile is also very high because there's no record of you at the credit bureaus showing that you can actually repay your debt. So that's just how banks determine what the rate to charge you. But the prime lending rate, it's the base, right? The other important thing that I really want to speak to in this episode, it's around fixing your interest rate or leaving it as a variable rate. So if you go to a bank and ask for funding or a loan, automatic, they'll give you a variable rate. Variable means it's linked to the interest rate changes. So if Reserve Bank comes and then they increase interest rates, it means your rate will increase. If they decrease it, it means your rate will decrease, right? However, at any point when you feel like, or when you know you have insights that the interest rates are likely to start to increase from their current levels, and you have a long-term debt, like let's take a home loan for example, or a mortgage, you can actually contact your bank to fix your rate for a particular term. Could be 12 months or 24 months, depending on what your bank can do, right? Fixing your credit rate, what it does is, at any point in time when there's interest rate increase and you fixed your rate, it means you are not impacted. Similarly, if you fixed your interest rate and interest rates come down, or the Reserve Bank brings down the repo rate and the prime lending rate, you are still paying a fixed fee. You're not going to benefit because now interest rates are coming down, while on the other hand you fixed your rates. So it's always very also important, when you fix it, it has to be informed and at the right time. It's always good to fix when we are at a cycle where interest rates are going up, right? But if interest rates are going down, variable rate is much favorable. So you can do that by contacting your bank, and then they can tell you, or they can give you a code to say, if you are to fix your interest rate, this is how much your new rate would be. That's also what I wanted to talk about, which I think is very important and will help you to make informed decision in as far as managing your debt and managing your finances. I think we've come to the end of our episode, and yeah, thank you guys so much for your support up to so far. I keep saying that it really gets me going. If you haven't also subscribed to TBD, the Balcony Dialogues, and you're really into this type of content, you enjoy this content, please subscribe so that we have more people who subscribe to the channel, and in future we can start to monetize and make the content even more appealing and interesting to you. Thank you guys so much. Ke a leboga. Pula. Thank you. Bye.